order the December 15th meeting of the Federated Retirement and Healthcare Trust. We will have a roll call of members. Vice Chair Jennings.
Here.
Trustee Chandra.
Present.
Trustee Kelleher. Trustee Kelleher is absent, I believe. Trustee Linder. Trustee Linder.
Sitting down now.
I can see him. We're going to mark him as present.
Recording in progress.
And Trustee Avasti.
Here.
Yeah, I'm
Thank you.
present.
Thank you. Trustee Linder is present. A few ground rules. We are continuing to meet virtually under the auspices of AB 361. All votes will be roll call votes. If not speaking, please be on mute to cut background noise. For discussion items, each trustee will have a turn to speak in roll call order more than once if desired, and the public will have an opportunity to speak on each item after trustees. We will take a break at about 10 o'clock and another break at the end of this meeting. Another break at 1 o'clock to accommodate the Civic Center broadcasting system. Board members are asked to please stay on the Zoom after the regular meeting ends so that we can have our individual committee meetings, especially for AB 361 purposes. I believe there is no sunshine to wave. Do we have a motion to accept the consent calendar?
So moved.
Moved by Trustee Linder. Is there a second?
I second it.
That's a second by Vice Chair Jennings. Any comments? Any public discussion? Vice Chair Jennings, how do you vote?
Aye.
Trustee Chandra.
Aye.
Trustee Linder.
Aye.
Trustee Avasti.
Aye.
And I vote aye as well, the chair. Okay, let us proceed then to the agenda.
Chair Horowitz, I'm not sure if you allowed for the public comments.
Yes, well, we will allow for public comments right after orders of the day. And I believe since we have just done orders of the day, we will do public comments. Thank you. At this time, members of the public may comment on items not included on the agenda, provided that the matter is within the subject matter jurisdiction of the board. Members of the public who wish to provide comment at this time may do so by raising your hand in the Zoom application or by joining by telephone. Please state your name for the record prior to providing your comments. Speakers will be limited to 3 minutes. In addition, public comment on items listed on the agenda will be taken at the time the agenda item is heard. So are there any members of the public wishing to address us at this time? Are there any hands raised? Okay, seeing none, we will proceed to the consent calendar. And I think we had a vote to accept the orders of the day. Do we have a separate vote for the consent calendar?
Chair Horowitz, I think we took the vote already on the consent calendar.
Okay, we did. Thank you for keeping me on track, Council Chin. All right, so proceeding past the consent calendar. Agenda item 2 is death and survivorship notifications. At this time, I'd like to take a moment of silence for those who have served the city and who have now passed. Thank you. Proceed to the next item. And that is oral update from the CIO.
Thank you, Mr. Chairman. Good morning.
Thank you.
So I will today we will be discussing second quarter private markets performance and third quarter pension plan performance. And when I say third quarter, of course, it's the first quarter of the fiscal year. But before we get there, I have, as always, returns from Makita. These are unaudited preliminary returns as of 12/13. Does not include the big sell-off today. The Fed pension plan was up 2.97% fiscal year to date as of Tuesday, and the healthcare trust was up 3.48%. So again, these are unaudited estimates as of Tuesday. With that, Mr. Chairman, I'm going to actually invite Casey Boyer from Neuberger Berman to present item 3B.
Great, thank you.
Perfect. Thank you. Appreciate as always, the chance to present to your board. I will take just 1 minute and share the screen. Okay, so as Prabhu mentioned, we are sharing our Q2 performance with the board today. I will.
Can we make the it just a bit larger if we could?
Yeah, let me put it to the full full screen. Is that better?
Great, thank you.
Yes.
I'm sorry, please go ahead.
Yes, no worries. Thank you. As I mentioned, Q2 performance, I will probably primarily focus on this page today, just kind of from a higher level of what we experienced in Q2 and Q3. But as always, happy to answer any questions on more of the underlying investments or movement if you would like. So as a quick reminder, we are managing this private equity portfolio, and we include primary fund investments, secondaries, and co-investments. Co-investments being the direct company investments that we make alongside private equity managers. One of our main goals here was to ensure that we were committing regularly by vintage year in a very consistent manner. That continues to be the case. We work very closely with the staff to maintain annual and further out model portfolios of how we plan to build this program. Currently, San Jose Federated has a $325 million program with Neuberger. And of course, you'll see on the left, the legacy investments prior to Neuberger's information in the middle, and then the combined returns and statistics on the right. So looking specifically at Q2, overall performance for the program was down slightly. When you compare that to the overall market, it was generally in line. We actually each quarter look at our platform overall to kind of see where returns come out. And across our entire platform, buyout returns for Q2 were down about 3%, and venture was down about 7%. Your program specifically for Q2 was down about not quite 4%. So if you kind of take those two into consideration, pretty much on par with the rest of our platform and what we would expect the rest of the market to look like. In Q2, we did distribute additional capital back to the program. So we distributed 4 million, currently a total of 42.5 million distributed back. Of course, a net value remaining of almost $350 million. A net multiple for Q2 of 1.8 times. It was a little over 1.8 times, and a 29.1% net IRR. So good performance. Obviously, looking at Q2, things did come down slightly, which we were expecting given the markets. Just briefly on Q3, we actually have reported on that already, so I can give you actual specifics. But again, the portfolio was down a little bit, a little over 3% overall. And again, very similar to what we saw across the rest of our platform, across buyouts and venture. We did in Q3 also make another distribution back, which was about $2.6 million. So we are still seeing capital come back to the program, which is good. We started this program 5.5 years now. And so it's nice to see that we are seeing those realizations come through, even as we're making new commitments. We're still able to distribute capital back. Those were kind of my main takeaways from this quarter. I will open it up for questions. Again, I'm happy to go further into the deck if anyone has any questions.
Well, I have a generic question. We know that the market took a hit, interest rates going up, et cetera, but is there anything in particular that's driving this particular equity market down?
Yeah, I mean, typically, private equity, it is tied to public marks. So in Q2, the public markets in comparison were down 20 to 25% at the end of Q2, which is, as I mentioned, for our platform as a whole, Q2 was down about 3% for buyout and 7% for venture. So in comparison, each quarter private equity companies are valued, and some of that is based on where public marks are as well. We're doing direct comparable analysis to public companies. So there's just an inherent connection between public going down and private equity going down as well. I would say in Q2, companies were still performing, their financial metrics were still doing pretty well. And a lot of the GPs and private equity funds we were speaking to still had, a lot of confidence in their investments. That's still the case today to an extent, but I will say there probably are more cracks in the system. There's not quite as many deals or transactions being completed, and it's really kind of just the best of the best assets that we're seeing come through. So it is tied to some extent to public markets.
If I can follow up on that question, so the delta between the public markets and the private markets, one down 3 or 4%, and the public markets down 22%, is that unusually large delta between the two? I understand private markets are going to be more muted, more attenuated than public markets, but do we track the difference between the two on a regular basis? And is this an unusually wide margin between the two, implying that perhaps private equity has more to go in terms of being marked down?
I would say it is high. It's not unusually high during market volatility like this. The way public markets performed at the beginning of 2022, as we all know, was just very volatile and did drop substantially. So it is higher than normal. But I would also say that you have to take that in the context of how unusual that market was for public markets. I do expect that private equity marks will come down next quarter in Q4. Not sure what Q1 will look like, but I think one item that we've known and that we've tracked historically is that private markets, there's kind of two things. Private equity tends to drop or raise lower than the public market. So if the public markets go down, private equity will typically be less. And then the other item is private equity markets and valuations tend to lag public markets a little bit because it's a little bit of a wait and see. And private equity, you really can truly mark to market and look at the specific company and you have some leeway to, if the company is performing well, you don't just have to mark it down based on public marks. So I would expect for it to come down in the next quarter. I don't know going forward, but yeah, hopefully that answered your question.
It did. As an item going forward, I would love to see, if it is possible, a chart, a time series showing public versus private valuations. So we have some sense visually, for those of us who are visual learners, how the public markets are correlated with the private markets, so that we can see both the lag and the attenuation, the delta between the two. So we'd have a sense if this was a particularly wide margin between the two right now, or if it's historically normal at this point in the business cycle. So is that something you think you could be able to provide?
Yes, of course. Happy to.
And just to add, Trustee Horowitz, this is Dinesh from the investment team. At the investment committee meeting next Tuesday, we actually have a slide that shows this over the last 10 or 15 years, showing public equity valuations versus private equity. And it shows that, especially in 2021, there was a very wide gap where public markets were overvalued, and then that gap is narrowing. So a preview to next Tuesday when you will get that visual.
Right, and I swear I did not look at the attachments for the IC, so it seems our minds are in sync.
Great.
Which is a little frightening in its own way, but that's another story.
Okay, can I ask one more question?
Absolutely.
Thank you. So this is just big picture, generic question I'm asking. When the market goes up, I mean, what do you anticipate happening that will get this back on an upward swing? I mean, does it just follow the market? Is it just the whims of that? Or is it, the interest rates getting back in control? Is it, is that impacting these industries? Or is it, staff, I mean, what inherent variable is driving this?
And how cost of goods are moved. So, these companies we invest in every industry, industrials, business services, consumer, technology, healthcare. So we have a really good exposure, and that helps diversify away some of those inherent risks within each industry on, whether it's higher cost of goods sold for a specific type of company, or the supply chain is hard at the moment. All of those things contribute to this. So I wouldn't solely blame it on the public markets. I think all of those things are affecting the public market. So it's all kind of melded together, if you will.
Okay, I was just trying to get a big picture.
Could I make a point that I don't know if it'll be helpful? I hope it'll be helpful. It may end up being not useful. The difference between public market equities and private equity, and I'm not including venture capital, is the fact that one class of company is public and the other class is private. And the advantage of being private is you can make longer term decisions. Most of the public companies are really thinking about quarterly earnings because their stock is being bought and sold every single day. And so they have a lot of those pressures. With private equity, you really only know their valuations when they buy a company or they sell a company, but you can use the valuations in the public markets as a proxy. And they're pretty good proxies. But there's a reason why companies are taken private. And it's normally because, well, there's a lot of selfish and greedy reasons that companies are taken private, but there's also real fiduciary reasons, which is you can make longer term decisions outside of the glass fishbowl of being a public company. So some of the comparing of public to private is totally relevant, and some of it is kind of immaterial. I mean, you're making a decision to invest in private equity because you want to extract the longer term value that you believe your fund managers are capable of extracting, that they know how to pick companies, they know how to fix companies, that they have certain talent. So I think that's important to keep in mind, that this is almost like, there's a river flowing of capital, and a lot of that is public, and then often these eddies are these different strategies, and private equity is one of them. So just wanted to.
That's wonderful. Anurag, thank you so much. Seriously, that gives a bigger picture. That's what I was looking for. So thank you. I appreciate that.
Terrific.
Thank you. And just to add on to that, one thing that's positive on the private markets is the fact that they don't have to sell at a certain time. If they're looking to sell and the price isn't what they want it to be, they can hold it and they can continue to work on the company and wait for a time that it makes sense to sell.
Yeah, actually, which public fund managers often can't, because if their investors are redeeming out of their fund because they're panicking, they have to sell their positions in public companies at inopportune times. Which is why I personally never invest in mutual funds, but that's another story.
Oh, yeah. No, I really appreciate that, because that just for our non-investors, having that big picture view is very helpful.
Any other questions or comments from trustees? Any questions from the public? And please help me if anyone sees a hand raised. All right, let's move to the next item on the agenda.
Great. Thank you, Mr. Chairman. Thank you, Casey. That was a great discussion. And of course, there's a lot of market volatility these days. As a famous investor once said, in the short term, the market is a voting machine, and in the long term, it's a weighing machine. And he also said, when the tide goes out, we know who's swimming naked, and we will see that over the next few quarters. And with that, I'm actually going to ask Ms. Wyrick to talk about item 3C.
Thank you. Good morning, everyone. Can you hear me okay?
Yes.
Great. I have had a never-ending cold that is on its way out, so hopefully there's not too much evidence of it today during our presentation. Jared is going to share the screen for the private markets report, which we'll start off with. As you know, this is the public version, and there is some additional detail that we provide to the staff members. Page 1, you can see the summary. You can see here that every private markets program has an IRR in the second column from the right that is above what the public market equivalent IRR would be. So as you know, these individual funds call capital and distribute capital on a schedule that they decide after a commitment is made by the retirement system. So if we take a public markets index and assume that that funds were contributed and distributed on the same days that they were by the underlying funds, that's what that PME is. So the fact that the program IRR for every private markets asset class is above what the public market equivalent is a good sign of the program's success. And then the total internal rate of return for the program is 9.4. We'll start in terms of individual asset classes on page 5 with private debt. You can see here that the individual program, especially the funds that have been committed to, since that early round in 2010, have had quite strong returns. Again, looking at that IRR on the far right, and these are relative to peer IRRs rather than public market equivalents. So peer benchmarks made up of similar funds. You can see that most of the funds in the 2017, 2018 range have been doing quite well. Early 2019. You see one number for Eagle Point Income, that is much lower than its peer IRR. This is still a relatively young fund, but it has a lot of fixed rate loans in this portfolio. And so when we have an environment where interest rates go up, a lot of those loans are marked down because they're not, they're already set at their interest rates. Taking a look at page 7, the next program is real assets. You can see here the real assets program stood at 1.9% of total retirement system assets versus a 3% policy target. So this is still a young program, but it has benefited from energy prices recently. If you look at the IRR in the lower right of this page, you see an internal rate of return for the real assets program of 13.5% since inception. Taking a look at page 10, you can see the individual investments in this program, and you can see that most of them have been made so recently that the returns are not yet meaningful. We do see some outsized returns, in particular from Kimmeridge Energy 5 with a 42.7% IRR, again, benefiting from the higher oil prices as it was investing. GIP4 down the page, this is Global Infrastructure Partners, has a low IRR of 1% relative to 18.3 for peers. This is a relatively new fund, and really you can see that every other fund in 2020 still shows a not meaningful return. They did start collecting fees when the initial investment was made in 2019. So this lower return really affects shows sort of the J-curve impact that you all have been paying fees. And they have just started to make money. But you will see in the next quarterly report, if all remains the same, that we're now going to have about a 14% gross IRR. So since this report was put together, that number has changed. If we take a look at page 12, the next program is the real estate program. You can see here that it's at 3.9% relative to a 3% policy target, as total fund assets decreased as the market fell. Some of these programs are slightly above their policy target, but that's all right. That fluctuates over time. You can see a 7.4% total IRR for the program. And taking a look at the next slide, you can see there were 2 new investments during this quarter that we're looking at, the second quarter of 2022, Pradium and AIG GRE, 2 $10 million commitments. And then we can skip ahead to 15, where we see the individual funds. So again, quite strong returns from almost all recent funds. If you look at the 2017s, 2019s here, DRA, Rockpoint, actually both DRA funds with quite strong double-digit returns. Episo 5 is a European fund. It does have a lower IRR relative to peers because the US dollar has been so strong, which has negatively impacted some US dollar returns. Episo's return in euros is actually much higher than this 3.5%. So over the long life of the fund, we'll probably see various market environments for the US dollar, but that's why you see a lower return right now. The next program is venture capital on page 18. I won't go into too much detail because this is a very young program with not yet meaningful returns. Right now, a 0.2% weight for the program relative to a 4% policy target. So as you know, this program is still being built. There's a lot of other market information in the rest of this presentation, but I'm happy to take any questions on private markets before we get into the total fund performance.
Thank you. Any questions from trustees?
Again, just curious on the real estate portfolio, will that be getting hit by the rising interest rate?
All programs will be affected in some ways, I think, by rising interest rates. That said, there are certain sectors of real estate that have held up better. Obviously office and retail have been under stress, but you have things like industrial and, anything that goes along with the just-in-time shipping sort of economy and that sort of thing that has still been strong. So, there will be an impact like there is with everything else, but we don't expect it to be outsized relative to other investments.
What's just-in-time shipping for real estate?
The sort of, you need a lot of infrastructure around so that people can get their packages delivered in 2 hours. I know that when I look at Amazon for something, a lot of times it says it can be there in 3 hours. And so you need a lot of close by industrial sort of
warehouse
centers.
Warehousing.
Yeah. Okay, gotcha.
And any other questions from trustees? I did have a quick question on the PME IRRs way back at the beginning.
Sure.
And just wanted to confirm that the MB fund of one, the PME IRR is just 2.2%. That seems.
That's right. Yes, that's a great question. We actually looked into it in depth because of the same question when we presented to your sister fund. Believe it or not, that is correct. It has to do with the market environment recently and the time period over which Neuberger has been investing. So the the public markets, and the fact that they've fallen so much recently have been weaker. So yes, Neuberger's return looks even stronger on a relative basis.
As of June 30th, but that also reflects the lag in valuations for the private equity.
That's true.
Public. So the delta may not be quite as large. Okay, great. Thank you.
Right.
And if there are no questions, we can move forward to the next part of the presentation.
Great. Jared is going to briefly discuss total fund performance.
Thanks, Laura. Good morning, everybody. Do a couple of high-level overview slides here on the economic environment and returns, just from a high level. So on page 5 here, you can see that after a great 2021 that everybody knows about, 2022 has been quite the opposite. And 2022, unfortunately, marks the worst start ever for the bond market. So you can see the year-to-date through October here, down almost 16% for the Barclays aggregate index. That's, like I said, the worst start ever. And we have a slide in a minute. It's actually the worst one-year period as well. If you remember at the beginning of the year, the consensus view, or at least the popular view, was that there would be a couple of Fed rate hikes this year. That clearly didn't end up happening. There's been 7 rate hikes this year, a few of them pretty substantial. So there's been several macro factors impacting all markets that Casey touched on, inflation, interest rates, the path of future growth, the war in Ukraine, China lockdowns. All of these things have been headwinds to different asset classes. One bit of good news is that with bond yields as high as they are now, prospective returns going forward are much more attractive than they've been, especially in the bond market, than they've been in a long time. I'll move forward here. And please, if anybody has any particular questions, please stop me along the way. Otherwise, I was going to go through fairly quickly. Page 12 here just shows the yield curve over different points in time. You can see the green line is what the yield curve was like at the end of last year, so December 31st of 2021. You can see it was upward sloping, but very low on the chart. Fast forward 10 months to the pink line on the top. Yields, as you can see, are a lot higher across the board. And also the yield curve is inverted between the 2 and 10 year. You see the 2-year yield is actually higher than the 10-year yield. So sometimes in the past, this has meant that a recession occurs at some point in time, sometimes several months after this happens. That doesn't always exactly happen that way. And there's also some suspicion by some people now that part of the reason the 10-year is so low is it's attracting so much foreign investment because U.S. yields are so much higher than everywhere else. So there may be a separate reason why the 10-year in particular is lower, and it may or may not be directly related to the economy. So time will tell on that. Page 13 just shows kind of the topic of the year, which is inflation. You can see here that the green bar in CPI has been much higher than it's been in the past 20 years, and you have to go back to the 80s to see similar levels of inflation. But hopefully it has peaked. You can see that it's trending down more recently. One issue, though, just to keep in mind is that Fed rate hikes are targeting not this exact measure of inflation, but something very similar. But Fed rate hikes, they don't really impact supply issues or the war in Ukraine or China lockdown. So there is, some uncertainty on the future path of the economy from here. So those are the slides I was going to touch on in the economic overview, but I'll stop here to see if anybody wants to touch on any other topics from a broad macro standpoint.
Any questions from trustees? All right, let's proceed.
Okay. I'm going to jump ahead to page 32. So you can see here 2.7 billion in assets at the end of the quarter. That's basically the same asset number as there was at the end of June 30th, so the prior quarter. Essentially, inflows offset investment losses for the quarter to end up at basically the same place. Markets have done quite a bit better since September 30th, so we would estimate the value of the fund today something more like 2.9 billion. You see that all allocations are near target, as is always the case. Here on page 33, we have some performance. So if we just focus on the top section here, you will see that returns, 1 year and shorter are negative. 3 and 5 year returns are still okay. So while certainly nobody wants to see negative returns, there are several bright spots on a relative basis to highlight here. The plan has handily outpaced the 60-40 portfolio. So if you look at one of the italicized marks here in the middle, you see that the plan across multiple time periods has beaten the 60-40 portfolio by quite a bit. You'll also see peer relative ranks. So the rank of the plan is on this bottom section here. So if you look at 1 year period, it's almost top quartile performance. For the 3 years, it's almost top decile performance. So really strong peer relative ranks inside of 5 years. And then finally, if you look at the policy benchmark or the investable benchmark, you will see outperformance there as well across most periods. So considering a very difficult backdrop, I think staff has done a very impressive job against a very challenging environment to generate outperformance against basically everything that we're looking at here. And in the interest of time, I wasn't going to stop on any particular strategies, but I will just point out something else that is impressive here. This is a 3-year snapshot on return in the first column, risk in the second, and then basically 2 different measures of risk-adjusted returns here on the right. So if you look at the plan's rank here, you'll see a near top decile return for the 3-year period, still better than peer median risk. And so you put those 2 together, you get a Sharpe ratio, which is risk-adjusted return, looking at all risk in the top quartile. Sortino ratio just focuses on downside risk, which is the risk most people care about more. And if you look at that, the plan has been top decile against peers in that metric for the 3-year period. So very strong relative performance. And like I said, a nice job by staff to get to that point. So those are the only formal comments I was going to make on the pension plan, but happy to take any questions.
Okay, thank you. Are there any questions from trustees? Any questions from the public? Okay, looks like we can proceed.
Yeah, I'll hand it back to Laura.
Thank you, Jared. So the next topic here, which will be very quick, is the Healthcare 115 Trust. Total market value as of the end of September of 342 million. And you can see that the current allocations are relatively close to their policy. If you take a look at the next slide, you can see performance. So as you recall, you have a riskier healthcare trust than the peer group. And so that over most of the last 12 years or so since the global financial crisis, that has been very strong peer relative returns for your healthcare trust. In a down market environment, though, having a riskier portfolio hasn't been as advantageous. And so you look at peer relative returns dropping to the lower percentiles. You see a 3Q 2022 return of -5% and a 1 year of -13.7. If you look at the three-year return, given that most of that last 3 years was a strong market environment, you still see a pure relative return of just about top quartile over that longer market cycle. Individual asset allocation, as you know, is in some of the same managers as the pension and also in some index funds. So we don't have any comments on those individual allocations, but I'm happy to take any questions on the healthcare trust.
Thank you. And are there any questions? Any questions from the public? Okay, thank you. Move forward.
Yeah.
I think that concludes the investment section, Mr. Chairman. Thank you, Laura and Jared. I'm happy to take any questions if the board has any questions for me.
happy holidays to everyone if we don't present to you again. I guess we'll see some of you folks at the IC though.
Great, thank you. All right, if no further questions for Mr. Polani at this point, we can move to the next agenda item. And that is what is the next agenda item? It is for a old business discussion and action on the final pension valuation results as of June 30th. And I believe Mr. Hallmark will present. Since this is a simply review of final results when we have already seen the preliminary results, if we can just focus on any areas of difference between the final and the preliminary that we need to focus on, that would be most helpful.
Okay, good morning, everyone. Let me share my screen here. All right, so yeah, last month we presented the preliminary results, a very brief overview of the preliminary results. Today we have the final report attached and then a PowerPoint going over those results and in particular looking at projections. So a lot of our presentation here will focus on the projections, which we have not presented, and the sensitivity of those projections. Later in the meeting, we will be presenting the preliminary OPEB valuation results, and we'll be back at the January meeting with the final version of those results. So with that, as we discuss frequently, this valuation sets the contribution rates for the fiscal year end 2024. So they go into effect July 1st, 2023. And that's the main takeaway from the valuation. We're also looking at the funded status and other factors. So here's our chart of the funded status, which really has not changed much since the preliminary results. I don't think it's changed at all. I would just note that the liability here for in-pay status is about 70% of the total liability of the plan. So it's very heavily weighted to people already receiving benefits. And we'll talk a little bit more about tier 1 versus tier 2, but the details are shown on the right chart here. And you can see that we're still predominantly tier 1 liabilities and assets. Tier 1's funded at around 55%, whereas tier 2's funded at about 95%. But it's a much smaller portion of the liability. We wanted to provide you some comparisons, both to national data and California data. So this is looking at the funded ratio based on the market value of assets. The gold diamond is the Federated plan, and the bars on the left chart are the range of funded ratios in the public plan database, which takes about 220 public plans across the country, the largest public plans. San Jose is not in that database, but a number of the California systems are. You can see back before the Great Recession, we were around the 50th percentile, the median. And since then, though, we've dropped below and have been below the 25th percentile for most of that period. In California, I think Harvey raised this in a prior meeting. We have been the lowest funded plan in the state of California for a number of years. There is another transit district that's right around the same funded level we are. And last year, with the excellent returns we popped up, And we're not the lowest funded. We'll have to see with the 2022 valuation results. But we've been among the lowest funded plans during that period. But looking back over the last 10 years, we can look at what has caused the unfunded liability to increase. And so this chart shows year by year the different components. And there's a couple things to note here. First is 8 of the 10 years, the net amount has been an increase in the unfunded liability. And that net amount is represented by the blue line. Now, about half of it, over 500 million, is from assumption changes, which are these purple bars, which were dominated in the first 4 years of the decade with significant reductions in the discount rate, big improvements in mortality, and some other assumption changes. So there were some significant assumption changes. That's become less of a factor more recently. The second largest contributor has been investment returns. These are measured on the smoothed actuarial value. So there was a little bit of the loss carrying over from 2008-9 being smoothed in. But our investment returns had been below the assumption until 2021. And now we're getting the benefits of those 2021 returns offset by smoothing in the 2022 returns for these last 2 years. There's not been much in the way of benefit changes. The other big piece increasing the UL has been our liability measures, which have largely been due to salary increases in the last 3 years. There's also some retirement experience in here that has increased the liability. When we do the experience study coming up, you can look for some assumption changes that may adjust for that experience, that recent experience. The positive story here that we want to focus on a little bit is where we have taken contributions. So over the last 4 years, contributions have worked to reduce the UAL. Prior to that, our contributions were not high enough to pay both the accruing benefits and the interest on the UAL. And so the unfunded was increasing just with the interest on the unfunded. And so we've worked hard to get those contribution rates up. We've gotten them up now so that we are starting to pay down the UAL with the contributions. Here, we're looking at the contribution rates from the last valuation and this valuation on the left, and the dollar amounts on the right. Starting with the rates, or starting at the bottom, the light purple is the member rates or member contributions. You can see there's not much change in those. The dark purple is the city's normal cost. That's the contribution for benefits attributable to the next year of service. So if we were 100% funded, that would be it. That would be the city's contribution right there at about $47 million. The dark gold is the interest on the unfunded liability. And then the light gold is what we are paying in principal. Now I have to say these are expected amounts because, for example, the fiscal year end 2024, we're calculating this as of June 30th, 2022. So it's the expected amount a year after that. But we are expecting to continue to pay down the UAL with about 42 million of the city's 216 million going to actually reduce the UAL.
Can I ask a quick question here?
Sure.
So it looked like and this is just for my own edification. So for because we're at a low funding status, I see between fiscal year 2023 to 2024, the city's normal cost went down. Is there a reason for that?
Yeah, that's because of the transition to tier 2. So the tier 2 members have a lower normal cost. And so the rate goes down as we transition from tier 1 members to tier 2 members.
Okay, but then the membership number is also down. Wouldn't the tier 2 members also pick up some of that liability as well? I guess I'm just wondering why both figures for the normal cost for the city and the members both went down for 2024.
I don't recall exactly the differences here, but the dynamic is a little bit different in that in tier 2, the members in the city pay 50% of the normal cost each, whereas in tier 1, the city pays 8/11 of the normal cost. And so there's a bigger impact on the city going from tier 1 to tier 2 than on the members.
Okay, but the numbers are going down from the one fiscal year to the other. So
right.
And that's because tier 2, it's based on the normal cost of the tier 2 benefits.
Are you assuming more tier 2 employees in?
We have more tier 2 employees.
2024,
We're assuming a continued trend.
that ratio?
Yeah.
Okay.
And we'll get into that tier 1 versus tier 2 a little bit later here, but that's
what's
this has
driving.
been kind of a long-term trend where we're transitioning from tier 1 members to tier 2 members. And it has an impact on the normal cost right away. It does not have much impact on the UAL.
Right. Okay. Thank you for highlighting that.
The other thing to note here is the reason the principal payment is going down, oops, sorry, is that this was based, the 2023 calculation was based on 2021 assets. So we had the really good investment returns, the assets went up, that reduces the UAL and the interest on the UAL. So more of the contribution goes towards the principal. With the investment losses, we're smoothing those in terms of the contributions, but this calculation of the interest on the UAL fully reflects those losses. So the interest on the UAL went up to reflect the investment losses, which meant there's less available to pay the principal. Okay, with that, I've got one more slide here is wanted to focus on that UAL principal rate and show you how you compare to other plans. This is a slightly different measure of it because this is backward looking. We're looking at contributions that actually came in compared to the interest on the UAL at the beginning of the year. And the bars represent the plans in the public plan database, the 220 national plans, and the diamonds reflect the San Jose. And so you can see we were below paying any principal. We were paying negative principal on the UAL until 2019, where we started breaking even and then really starting to increase. So we are expecting this to be above zero going forward. We can have drops if temporarily because we smooth the returns on assets. But compared to other plans, we've really made progress picking up to the median. And I can tell you for 2022, we'll be well above the median.
But that's because of the investment gains we had. Right?
That was the investment gains. Will come back down a little bit, but we will still be above the median, which will be a big switch from where we had been historically.
Great.
I think Mr. Polani needs to keep on doing that, right?
Well,
That's
I
the
believe
secret.
we all do that through our judgments of asset allocations.
I know, but then making that go through. I'm being cute. Okay.
So I'm going to turn it to Stephen Hastings to run us through the next few slides here.
Actually, I'm going to jump in.
Or
Bill.
Jackie, I'm sorry.
Morning, everyone. We're going to switch to looking at some of the projections now going forward. So this first slide here, this one on the left, you've got a projection of your funding ratio. On the right, you've got a projection of the dollar amount of your unfunded liability. So if you look on the left there, the bars are your liabilities, the lines are your asset values, and you can see that first of all, these projections are based on the assumption that all the assumed assumptions will be met going forward, including in 2041 when that comes off. If you look at this, I mean, you can see a lot of this is driven by that particular base, as well as the purple bars, which are the different assumption changes over the years. You can see everything above zero is considered a loss. Everything below zero is a gain. So you have had far more losses than gains over the years. But hopefully going forward, that trend will even it out. So you'll kind of see more above this, more below the zero mark than above. But what's key to look at this here is if you look at the pattern of your amortization payments, this is going to drive the pattern of your contribution rates going forward. So you can see in 2041, when that 2009 UAL gets paid off, you expected to see a huge drop in that contribution rate there. So moving on from that, you can see that this is the projection of the contributions. On the left is the contribution rates, and on the right is the contribution amounts. And you can see there, it follows the same sort of pattern. You're going to see that huge drop in 2041 when that base is paid off. You can see we are showing what was projected with last year's valuation, the 2021. As we've mentioned before, the difference why it's increased now is just we're reflecting those asset losses of the year. But in general, it follows the same pattern each year. It's just the different gains and losses just drive whether it goes up and down a bit. But the same pattern is continuous. So you can see if you look on the left, you have a downward trend in your contribution rates. And that's because you're looking at your contributions as a percentage of payroll. Okay, but on the right, you have that uptick going forward and then that drop. And that's because these reflect actual contributions. So as you're expecting as you're expecting payroll to increase over time, so you expect the dollar contribution to increase, but the actual percentage is decreasing in the same amount. So with that, we'll stop. Are there any questions on the projections before we move forward?
Any questions from trustees or from the public? Okay, let's go forward.
Okay. I'll hand it off to Stephen for this.
Good morning, everyone. So I'll be taking over to look at tier 1 versus tier 2, as Bill alluded to earlier. So on slide 14, on the left side, we're showing in blue tier 1 counts and in green tier 2 counts. And you can see over time, the blue has reduced and the green has grown. Now we also show by bucket. So, deferred, terminated participants, in-pay participants, and the darkest components are the active participants.
Can I ask a clarifying point? I'm sorry, I was reading through this and I'm sure you guys have explained it to me before, but when you say terminated, what's that mean? Does that mean, I just don't, when I hear terminated, I hear, someone was terminated, no longer works for the city because the city asked them to leave. But I don't know if that's what we mean when we say terminated.
We have several names for them. You can think of them as deferred vested as well, but it's someone who no longer works for the city, but did work long enough to earn a pension that can commence out in the future.
So that's what terminated means here?
Yeah, it includes voluntary terminations as well as involuntary.
Okay, but they didn't meet the 5-year requirement, so they're not vested. Is that it? Or they took their money? Oh, go ahead.
They did meet it. So they're entitled to a retirement benefit when they get to retirement age, but they haven't.
Oh, okay. So they didn't take the money. These are people who left the city or were asked to leave the city and kept their money in the plan. Yes? Okay,
Correct.
thank you. I appreciate it.
Yeah. So those are sort of the bright blue in the middle there, the blue section. So they're a smaller portion. The in-pay are the largest portion, the light blue. But I wanted to focus on the actives, right? So the dark green and the dark blue. You can see that over time, the tier 2, as we're, the transition that Bill was discussing earlier, tier 2, if you look at 2022, is now what, 2/3, right? It's 2,500 versus the roughly 1,300. So tier 2 is now about 2/3 of the actives. And on the right side, we're showing the active member payroll, and you can see a similar pattern where it's nearly 2/3. So the tier 1 group is an older group, right? So it's not exactly the same as the headcount split, but roughly 2/3 of the payroll is now for tier 2 versus tier 1. So moving to slide 15, we see a very different story when we look at the liability, right? So here you can see the blue just completely dominates. On the left, we're showing the actuarial accrued liability, and only in the most recent years do you start to see a chunk there for the tier 2 actives. Now there's a very, very small, it doesn't really register a bit for tier 2 folks that are in pay, or again, the deferred vested. And on the right side, though, you can see the assets, which are similar, but the assets, the 7%. So I think it's 4% of the liability is tier 2, but the assets 7% are tier 2. So what does that mean? Well, as Bill mentioned earlier, tier 1 is 55% funded, and tier 2 is 95% funded. So there's the difference in funding status. But again, 93% and 7% is very different from the split you see on headcount, right? So you have longer service folks and a final pay formula that really sort of accelerates late in the career in terms of the liability that's being accrued. So we just wanted to point out that I guess the key takeaway is tier 1 still dominates, even though the active headcount is now more tier 2 than tier 1.
They dominate because they're in pay. They're moving towards the in pay, and they're more expensive.
Yes, a more mature group.
And they have longer service, so they have larger liabilities.
That's what I mean. Yeah.
Correct. So on slide 16, we show, so what does that mean in terms of contributions? Well, you can see that the purple at the bottom, as Bill discussed earlier, the normal cost is similar actually between tier 1 and tier 2. Now the split is different, city versus member, but you can see those purple bars are roughly, not too far off. The big difference is the UAL, right? So all that liability that is only 55% funded, well, there are amortizations to pay that off over time. So the gold is the big difference, where you see very, very tiny, you can barely see it, a bit of gold for tier 2, but very large UAL contributions for tier 1.
So I should know this, but I don't, I forget. If you're tier 2, you're an active and are you paying off? So once, tier 1 is pretty much out of the mix, or very close to being out of the actives, are tier 2 paying a higher percent of the unfunded liability for the tier 1 people, or does that fall onto the city?
The tier 1 UAL falls entirely on the city.
Okay, not on the tier 2 employees.
Right. The tier 2 employees pay 50% of the tier 2 UAL. But
okay, all right.
Much smaller.
Well, that's fair for the employees, right? Okay.
Well, the object is to not build up the large UALs for the
That would be good,
tier two.
right? Yeah, but we know how that works, so.
So next we're going to look at the maturity of the plan. So as your plan progresses through time and it becomes more mature, it does become more sensitive to certain risks within the plan. So one thing we look at is your membership count and your support ratio. I know you have seen this before, so I'm not going to dwell on it too long, but just a reminder that your support ratio is your inactive, so your in-pay and your terminated vested members divided by your actives. So basically, for every active that's contributing, how many inactives is it supporting, and how many inactives are they supporting in the plan? So you had that big drop in your active count with the recession, and it has slowly been ticking up since then, which is the blue and the teal bar combined, but it hasn't quite got back to the 2009 level. Also with that recession, you saw a huge uptick in that support ratio, but it really has stabilized since then. So it's still ticking up over time. That's normal for a plan as it matures, but it's ticking up at a fairly stable level, not that huge increase that we saw. Another thing to look at is we look at your leverage ratios. The first one is your assets. So what that is your market value of assets divided by your payroll. So it's really what it looks at. The asset leverage is your sensitivity to your investment returns, right? So how does that differ from your assumption, and how much does that impact your contributions? And with the liability leverage ratio, that's really looking to sensitivity of your plan experience, particularly assumption changes. So any changes like that, how much of an impact is it going to have? When we're looking at it, if you look at it, this again is looking back at that public plan survey, which is about 200 plus large plans. And then we compare San Jose to them. The gold bars is just for Federated, and the black triangles is police and fire and Federated combined. So you can see that Federated has a lower leverage ratio in both regards. In both graphs, it's got a much lower leverage ratio than if they were combined with police and fire. What this really does is just to reiterate just how susceptible you are to changes within the market and assumptions. This here is just kind of leading on from that, just the sensitivity on the left. We have the sensitivity to a discount rate change. So this is changing your investment return assumption. On the left is your current assumption, and on the right would be what if you lowered it by 100 basis points. And you can see that with that higher liability leverage ratio that we showed in the past, you're much more susceptible to if you change that assumption. You can see that your total city contribution would increase almost 10% with that change. The graph on the right is your interest cost at risk. And what this really is the effect of investment returns. So actual investment returns in comparison to the assumed for the plan. So on the left is what we, here's the current assumption. In the middle is what's expected if you have the investment, if you earn 6.625 within the next year. And on the right is if you were to have a terrible year, so like a minus, we use the different formula, we're going to, but about minus 21% return. That's how it would affect it. So you can see that just by that, by having a massive negative return, it would increase your contribution rate by about 3%. So, and just, just to reiterate, I know Bill touched on this a little bit before. If you look at the different buckets of each of those bars, you can see that the investment returns don't really affect the normal cost rate and the member rates that much, but they have that biggest effect on the interest on the UAL and the UAL principal. So.
Yeah, I would note here that this 56.7 includes the 5-year smoothing. And so you're not getting the full effect of that investment loss in the first year. There'd be more increases after that. You can see that the interest on the UAL, which is calculated on the market value of assets, that increased almost 13% of pay with just that 1-year loss. So that's more indicative of the long-term impact on the contributions. The other thing I would note is for the typical plan in the public plan database, the discount rate change impact would be about half of what it is for your plan. So for a typical plan, if they dropped their discount rate 100 basis points, or if your plan was similar to the typical plan, it would only go up by about 5% of pay. So you are more mature, and so that makes these rate changes more significant for the same type of risk that you experience.
Okay, so I'm going to now talk about projections on a stochastic basis. And for this, we look at 10,000 trials based on the variability of asset returns, based on the capital market expectations. And then we sort them and you have percentiles. So if we look at this graph, you can think of sort of the center there would be the 50th percentile. And that line is you can think of as the baseline. And then out from there, we have the other percentiles with the red being the sort of worst outcomes, 50th to 75th and 75th to 95th in light red. And then down below, we have 25th to 50th in dark green and 5th to 25th in light green. So those would be the sort of the better outcomes, right? But you can see here, if we look at, right, the dispersion starts to get pretty wide. So here we're looking at the projected city contribution rates. And you can see in 2030, those run from, roughly 25% on up to just over 70%. So that would be in sort of the 95th worst outcome. And then there's a little more dispersion from there even. But it gives you an idea of the variability of these results based on asset returns, and we're assuming no changes to any assumptions and no changes to the funding policy when we come up with these trials, 10,000 trials. So on slide 23, we look at the same results but by tier, and it's important to note we've put the same scale on these two graphs. So you can really see the difference between the two tiers, but again, you can see there's quite a bit of variability. On the left, we're showing tier 1, and that these are now dollar amounts, by the way. And you can see in 2030, it goes from what a bit under 100 million to just over 300 million. Or yeah, 2030, just under 300 million. So pretty wide range. That's not that many years out. Whereas tier 2, there's less variability, and there's less upside. Right, it's just sort of a floor there of the normal cost, but less downside as well. And a lot of that is because it's just such a smaller group, smaller amount of assets, right? So negative returns, for returns has less of an impact in terms of dollar value.
Okay, so I'm trying to understand this chart. Can you go back? I'm sorry, the baseline, and then you have the green below and the red above. So can you explain what the baseline is?
Sure, that would be like a best estimate, right? The 50th percentile. So that should be pretty close to the mean return being achieved, right? The 6,625.
Okay.
And so that would go, that would be more, it should be along the lines of a deterministic projection, right? Where you just assume 6.625 every year.
And if we do better than that, that's the green.
Yes,
And
yeah,
if we
so,
do worse, that's the red. Is that
yeah, so,
how I look at this chart?
Yes,
yes.
but the real
So-
point is understanding how wide those are.
Yeah, so I have a question.
Sure.
Why is there more downside as compared to the upside?
Mm.
Or
Yeah.
is it just exception?
I'm sorry,
There's a bigger swing in the green.
There's a
than
bigger
there is in the
swing on
red.
the downside.
Yeah, the green.
well, as costs go up, contributions increase, right? So that the funding policy kicks in. But if you have fantastic returns, there's nothing to sort of cap those, right? So you can have a surplus grow and grow and grow. And the only requirement is to pay the normal cost.
I think it's a little clearer on the next slide if you look at the UAL, there's really quite a difference in that dynamic.
Yeah. So on slide 24, you can see we're showing the projected, so that this is using the same results, right? But we're showing the unfunded actuarial liability. And so the baseline has, that the UAL starts around 2 billion, it gets down to 1 billion. In 2030, it's about 1.5 billion. But if you look at the dispersion, the red, right, is that gets up above 3 billion under the worst return. But in those cases, the contribution requirements are ramped up, right, because of the poor returns. So there's sort of a limiting effect. Whereas in a situation where there are fantastic returns, there's right, I mean the contribution gets capped at 0 plus normal cost.
And so what is the return? I mean, I see the chart, I see the dollars, but to get to that 0 in like 2025 or 2026, wherever, I think it's 2025, what is the return that is being assumed that would get you there? I don't understand how to find that on the chart.
That's not on the chart.
Okay.
Yeah, I mean, these are sort of sorting all the returns in order and ordering them sort of by the percentile. So Bill will have a deterministic example that gives you a better idea of what the return is.
So can I ask a question here too? So I'm trying to follow this as well. So these red lines here for the projected returns, it seems to me that one thing that we do have more control over in terms of guaranteeing the funding status would be handling the discount rate, because the returns here, these are just projected returns, right?
Yeah, with no changes to the discount rate.
Okay.
Maybe it would help. The baseline is assuming on average, the discount rate is our return 6 5/8. How did you bound that? Did you assume best case? The
Right.
bottom of the green line, is that up 100% a year, up 300% a year? And
That's my question.
We use Makita's capital market assumptions. So it's about a 14% standard deviation with a median return of 6 5/8.
So you could
so
roughly.
if you could refresh our memory, what is that average return over the next 5 years? At the best case.
You're leading right into this. here.
Okay, I'm an impatient man, so that's why.
Yeah, let's move on. So
Okay, so this will help explain the questions we've been asking.
yeah, so for over a 1-year period, you're seeing a 5th percentile return of -14.5 and a 95th percentile of 31.7. The median, we're not showing here because it's just the 6.625.
Right.
Over a 5-year period, you'd be looking at average returns ranging from -3.6 to 16.9. The stochastic results are hard for a lot of people to comprehend. I think they are advantageous for giving you the range, but we wanted to give you some deterministic scenarios so that you could get a better handle on those dynamics. And I think it will go to some of the questions that you were asking.
Yeah.
These are not meant to be realistic economic scenarios, but just to give you a sense of the sensitivity. So we did a 1-year shock scenario, both positive and negative, where we took these extreme returns for 1 year and then assumed we got our assumption. And then we did a 5-year moderate where we took the 25th and 75th percentile returns for 5 years. So that should be about half of the outcomes should fall between those lines. And so here on the left-hand side, we're showing the city's contribution rate and the ranges between those, where the light green is that 1-year positive shock. The light pink is the 1-year negative shock. And then the darker colors are the 5-year moderate, and the dark blue is our baseline. So the baseline is if we get 6.625% every year, we're expecting that contribution rate for the city to gradually move down until we get to that big base being paid off from 2009, then we drop significantly. But there's a range of those that goes really in the near term between about 40% and 65% of pay in terms of contributions. That's the range that we're looking at. It does drop faster with good returns. We've got some things built in, and that helps us move the contribution rate down, at least in the short term. But then it's kind of flatter after that.
And just to clarify, your 1-year shock, does it assume two things? Does it assume there's no recovery from the shock? That is, we go down and we stay down?
Yes, there's no recovery.
And which is quite unusual.
Yes.
And the 1-year shock also assumes no reallocation of our assets to take advantage of the shock.
Correct. It assumes that you rebalance based on your portfolio target, but you don't overbalance to take advantage of different price earnings ratio.
So it assumes both tragedy and stupidity at the same time.
A certain level of it.
Okay, all right. That is worst case.
Yeah, so again, none of these take into account any changes in board actions. It just assumes that you rebalance with your current portfolio. It doesn't take into account any changes we might make in contribution policy either, or assumptions or anything.
But even more important, no change in market conditions.
And no change in market conditions, correct.
After a sudden downward shock, so.
Right. So there are many limitations to these projections. They're really just to give you an idea of the sensitivity, particularly in the short term. The longer term, you kind of see how it plays out under the current things. But remember, we're only varying the investment return for either 1 year or 5 years. So after that, it's all 6.625.
Right.
The right-hand side, we're showing the same thing on tier 2 member contribution rates. This looks really wide, but I want to point out the scale is totally different. The scale is only going from 7% to 9%. So we're really looking at something like 7 1/3 at the low end, up to just shy of 9% at the high end, 8.9% of pay. And you see this big bounce here that I looked, that goes from 7.9 to 8%. So that's really just a 10 basis point change in the rate. But these different returns will have an impact on tier 2 member contributions. Just not a very significant impact, at least until tier 2 becomes much more mature. So it's something to monitor in the near term. It will be a management challenge in the long term, but that is probably beyond the tenure of the current board members.
Okay.
Then we just wanted to leave you with this handy chart to show you what the fiscal year end 2025 contribution would be, depending on the investment return you get this year for 2023. So on the bottom, we're showing the range of investment returns this year from minus 15% up to 30%. The left-hand side here, left-hand chart is showing dollar amounts, right-hand percent of pay. It assumes all other assumptions are met. And so we expect the contribution, if you get 6.625, to go up from 216 million to about 220 million. To keep it at 216 million, you'd have to get a 15% return. The range here goes from 228 to 210 million for next year, based on that wide range of investment returns. As a percent of payroll, assuming payroll grows 3% and all of the other assumptions are met, we're expecting it to go, the city contribution rate to go down from 54.6 to 53.9. Even if you get a minus 0.8% return, then we'd expect it to stay the same as a percent of pay. But the range here goes from about 51.5 up to 56 in a 1 year time period. Now, keeping in mind, these are smoothing in those asset returns. And so that 1 year effect is going to compound over the next four years. But this is what you can expect looking forward. I know Prabhu said you're currently at about a 3% fiscal year to date return, which would put you somewhere, just above 54% of pay here and somewhere just above $220 million for next year. So,
all right, so I'm
this as a
confused
reference
on something. What I'm confused with, the system would need fiscal year FYE fiscal. I don't know.
Fiscal year ending.
Oh, okay, that's what I thought. 2023 returns to exceed 15%. So the 24 city contribution, how did you get the 24 city contribution of 216.1? I mean,
that's what we calculated in this valuation and was shown earlier in the presentation. So that's set.
Right, that's set. So why would we have to exceed 15%? I mean, isn't that 216 based on our 6.63?
This is for the following year. If you wanted so for 2024, it's 216 million. To get
as it is now,
to stay
next year is slated to increase. So to get it to be flat, we would need some pretty good returns.
But I think also what's key here is that I think maybe the fiscal year ends are a little confusing in that the fiscal year end, that 2024, that city contribution, that's set. So based on the returns for fiscal year ending 2022, so the valuation that we've just done. The fiscal year end 2023 returns, so in those green bars, that's going to affect your fiscal year end 2025 contributions. So
you're like 2 years out. Like,
yes, it's 2 years out. It's like that 1 year delay. So I think, I don't know if that was maybe causing the confusion kind of going backwards if you look at the years, but it's what the contributions for your fiscal year end, your investment returns, they affect the contributions for the following year,
so because the investment returns are down this year, that's what's would be pushing the contributions up,
Yes,
regardless of the discount rate.
yes.
But I think it's also important to note that the current estimate for fiscal year end 2025 is higher than fiscal year end 2024. So it's not forecasted to be flat, it's forecasted to increase currently, and it will, to get it to be flat would actually be a big improvement.
Okay, so to maintain that is the returns have to go up. And we did have like 23% on the end of the prior year, so that was pretty.
Yes. Yes.
Okay, I get you.
Great.
All right, because, I mean, there's so much data here and you guys know it inside out, okay? So this is really easy. I'm gonna assume it's easy for you guys. Maybe it's not, but I'm gonna assume that. But this is not easy for the standard Joe Blow who's just gonna look at this, or even the budget office who's going to look at this. I mean, they're pretty sharp people, but still, like, this is your bill, right? This is what you have to pay. It just, making it simple, as simple as possible. I mean, this sheet is more, you can follow it easier, but it's not easy to follow, guys. It just isn't. So.
And in that vein, are there any other questions from trustees to clarify further? Any questions from the public? All right, well, I think this sensitivity analysis is always extremely interesting and informative for us. Billy, this concludes your presentation on this agenda item.
It does. I think we need the board to accept the report.
Is that right? Okay. So do we hear a motion to accept the report as presented?
Also motion.
We have a motion from Vice Chair Jennings. Is there a second?
Second from Trustee Chandra.
We have a second from Trustee Chandra. Any discussion?
Yeah, just a quick question for Bill, Mr. Chair. This is the final presentation, so the board also needs to take action on the results, correct? They haven't done so in the past. Is that right, Council Chin?
Yes, that's right. So, there should be, a lot of the presentation was projections. But is there a slide, for example, that has the final valuation results? I think that was in the beginning of the presentation.
Correct.
There was, I think officially what you need to accept is the
results,
the long report.
So accepting the long report, but also taking action on the
Right.
results so that the contributions can be implemented.
Correct. So could you pull up the slide with the final valuation results? Just so the board has it in front of them while they.
Yeah.
Thank you.
So this is what we'll be providing to the city as to their contribution for next fiscal year for
Correct.
23-24.
Correct. This is exactly what's going to be provided to the city for the budget projections and everything else, and it will be implemented in the month of July 2023 for the city and for the members.
Right.
But we will be back with the official contribution resolution that the board adopts. But
Yeah, correct. The board later,
these
we
numbers.
do prepare a resolution, so the board can also approve that, which includes the members' contributions and everything else, and the city. But I think we also usually take action on this, on your final results of the evaluation.
Right.
So when we look at this, again, it would be really nice. It says you're voting on that,
Right.
Yeah.
Well, the thing in the presentation, it was a confluence of two things. It was the final valuation results and then a number of sensitivity analysis for projections. So I just want to make sure that the board is clear that we're voting on the final results.
So we're voting on the final result. But when it says fiscal year ending 24, so the contribution amount, so the city would be contributing $216.1 million. Is that correct?
Correct. That starts in July 2023, Julie. So
Yes. All right.
The current evaluation results are for the upcoming fiscal year. This
one.
year, the city is actually making contributions based on last year evaluation.
208.8.
Correct.
Okay, so they're gonna see an increase of $8 million. It's a good thing they didn't do the special election, huh? I'm sorry. That was being flippant. Okay, so that's what we're voting on, to
So
approve
is-
this, and that's what the impact to the city would be.
Yes.
Okay,
And so
Thank you.
does your motion still stand?
sure, yes.
And does the second still stand?
Yes.
Okay. Is there any further discussion on the motion to accept the contribution amounts for fiscal year end 2024, which begins in July of 2023? Any public comment? So hearing none, we will have a roll call vote. Vice Chair Jennings, you
I,
vote to accept? Aye.
yes, aye.
Trustee Chandra,
Aye.
Trustee Linder,
Aye.
Trustee Avasti,
Aye.
and I vote aye, so it passes unanimously. So before we take our break at the 10 o'clock hour, I would like just to ask that Mr. Holmberg stay available, and we will take your next agenda item, which is slightly out of turn. Item 5C after the break.
Okay,
So at this point, we're going to be on a, what do we normally take? 5-minute break? I have 10:10, so we will reconvene at 10:15. Thank you. Hope all trustees are back from the break. So we were taking slightly out of order, agenda item 5C, I believe. And again, we turn to Mr. Hallmark for the preliminary OPEB.
Thank you, Mr. Chair. I have Mike Shunning with me, our healthcare actuary, to help me present this, but this will be a very brief presentation of just the preliminary results. We'll be back next month with the full valuation results.
Okay.
Again, the funding for this is very similar to the pension plan in terms of the premium subsidy for retiree medical benefits. The assets are held in a 115 trust instead of in the pension trust. And we're setting contributions again for fiscal year end 2024. The one notable difference is that member contributions are fixed in statute as a percent of pay. So we are not adjusting those. We are only setting the city contributions. The funded status dropped from 65% down to 60%. Based on the investment returns dropping. You can see the green line is the assets dropping compared to the bars of the liability. The liability also dropped, just not as much. And so we'll talk about what's driving that. Contributions, the member contributions are going down just because the covered population is going down. The city's contribution is remaining relatively level, increasing about 0.3 million. I do want to note here that we are talking about much smaller dollar amounts than the pension plan. So the charts show a completely different scale. The city's contribution for the pension plan was 216 million. Here we're just talking about 19 million. So keep that in mind. The active members who are eligible for full benefits is a closed group of tier 1 members who did not elect the VIBA. And so that group is declining every year. This year it went down by 8.6%. The member payroll that drives member contributions went down 2.3%. Other changes are, as you might expect, but fairly stable here. This shows the details of the funded status. The unfunded liability was 206 million for the explicit subsidy. It went up to 230 million, even as the liability dropped from 590 to 579. There's an implicit subsidy that we have to track for financial disclosures. It is not pre-funded. It's not under the board's purview to pre-fund. It's paid on a pay-as-you-go basis through the city's active health premiums. So that's what this middle column is. So with that, I'll turn it to Mike to walk through the changes. Mike, you're on mute. There you go. Nope, you're back on mute.
Finally, yeah, my
There we go.
computer's been doing really fun things this morning. Okay, so next slide, or because I'm very delayed right now. So,
You're on slide 6, showing the changes in the UAL.
well, my screen still shows slide 5. There we go. So the UAL actually did go up slightly by 24 million. And this slide really shows where the changes are coming from. And there was an $11 million reduction because the contributions were actually greater than the tread water amount. And the tread water amount is the amount of contributions that would need to be made to keep the UAL unchanged. And so again, we expect that to happen because we want to pay down the UAL. And then we actually had a $36 million gain due to liability experience being better than expected. And that was really driven by the actual premium increases that happened were slightly lower than what were expected last year. So we see a gain there. But then we saw a loss on the other hand, because again, investment returns weren't that good this year. So we had a $62 million increase because of that. And then we had some assumption changes, and that major assumption change was the long-term trend is slightly higher because of the fact that inflation is higher. So next slide. And so what the next slide then shows is, you know, over the past few years, what has been the overall source of the various changes in the UAL. And I'll wait for it to catch up to me. There we go. Is it basically, it actually has decreased by almost $70 million over the last 5 years. So again, we're making progress. And over about 153 million of that is actually due to the liability experience. So premium changes have actually been fairly positive over the last 5 years. A lot of it driven by the Medicare eligible population, that those increases have been a lot less, and in some situations actually decreases in costs. And then again, another almost 60 million because we're making contributions greater than the tread water amount, which is again, the intent is to pay down the UAL. There was a really slight increase of 7 million that's due to the benefit changes that happened. And that includes the implementation of the VIBA and formally closing the plan, and putting the in-loop program in place as well, which lets members delay participating in the program, which then helps the plan because you're not paying out premium costs for those people. A total of almost a $40 million loss though, because again, investments weren't quite as good as the expected rate of return, and then another $97 million due to assumption changes. And those are primarily due to the reduction and the discount rates that have happened over the past few years. So slide 8. I apologize for the pause because mine is so much slower for some reason today.
I think we're there.
Yeah, I'm still not there. I don't know what's happening to it. There we go. So this one actually shows, you know, really where your liability is coming from. And it splits it into between those that are in pay, so the current retirees that are receiving benefits versus the actives who aren't yet participating, and then those vested terms, so the individuals who've left the city are eligible to actually participate at some point in the future, just haven't started yet. And you can see that again, the vast majority of it is due to those who are currently retired and receiving benefits, almost 66%. The other piece to keep in mind with all of this is almost 70% of the liability actually happens once individuals are over 65 and eligible for Medicare. So that's really the big driver of the costs. And only 20% of it's due to the eligibility pre-Medicare. And then 11% of it's actually due to the dental benefits.
Yeah, so a lot of times people think the pre-Medicare costs are higher because the premiums are higher. But the way this subsidy program works is really heavily weighted towards the Medicare.
Why? I mean, are we paying the
Well,
percentage of
it's
the
a much
bill?
longer time period because they're lifetime benefits. Whereas the pre-Medicare is just from their retirement to age 65.
Oh, okay, so it's just the numbers.
Exactly. So you only pay
Situation.
Medicare
All right.
maybe 6 or 7 years, but you could pay the Medicare one for, 20, 30 years.
Right, but you are getting the benefit of Medicare picking up the bulk.
Exactly. The premiums are lower.
Okay.
Right, and so basically, again, as Bill mentioned, because the member contribution percentage is fixed and it's a closed population, so as the existing active tier 1, 2 members retire, their contribution continues to decrease. And so it's going to go down from 8.8 million in fiscal year 2023 down to almost 8.6. So it's going to just again continue to decline as those members retire. The city's contribution has gone up a little bit, and it's mainly due to the fact that investment returns weren't as good as expected, but it's going to go up from 18.8 to 19.1 essentially. But under the plan, the city has the ability to actually cap its contribution at 14% of payroll. And that cap is, as you can see, significantly higher than what the actual contributions are. So basically the city's responsible for paying the contributions, and it would have to get up to, get over a $50 million contribution before the city's cap would ever kick in. So they're well below the cap. And then the last piece is the implicit subsidy. And that's a piece that represents the difference between what the actual cost is for delivering benefits for those under 65 to what the premiums are. And that's because, again, since the actives and the pre-Medicare retirees pay the same premium rates, essentially the actives are subsidizing those early retirees, but that amount's being paid through those premium amounts. So that's not actually funded through the trust. The trust is only actually funding the premium pieces of it. But so this is just an accounting number that needs to be shown. And again, that went up by almost 14%. And we're going to tend to see larger increases in that as time goes on, because this is a closed group, you've got less and less from a percentage basis of retirees under 65 that are participating in that broader pool. And so therefore that tends to increase the differential between what the premiums paid are and what the expected cost is for the retirees. But it doesn't actually impact the trust, it's the funding itself, because you're only funding for the explicit piece of the actual premium costs.
So I think that's it. We'll take any questions you may have.
Great, thank you. Are there any questions from trustees? Any questions from members of the public? As this is a preliminary evaluation, I assume no action is required of the board at this time?
That's correct.
Okay, well, thank you so much, and we will see you next month.
Thank you, and have a happy holidays and a happy new year.
Okay.
Thank you. Same to you, Bill, and the rest of the Chiron staff. Thank you.
What is the next agenda item? I believe it is a report from the CEO. Is that correct?
I believe it is. Let's wait until staff can bring the agenda back up on the screen. Just to confirm, yes, you are correct, Mr. Chair. So thank you. Good afternoon, everyone. Just have a few comments. I wanted to start with the open enrollment. We just finished the OPE presentation for healthcare for retirees that ended last November 30th. The changes to actually perform and approve through the open enrollment will be reflected in the retirees December payment for January 23 coverage. We had, these numbers are not split between police and fire and federated, so they're combined, but we had over 700 changes submitted to staff. We had about 10 workshops of webinars offered through the month, 33 hours of personal appointments with health vendors. We had approximately about 100 attendees to our health fair, which was the first health fair in the last 3 years that we actually did in person. And most of those changes that were submitted were actually done through either via our member direct in our administrative system, followed by some of them that were actually either mailed in or walked into the office. So again, I want to thank all the members that took the time to go to the open enrollment, and also to the office staff. It is an extremely busy month for the staff work through it. So kudos to staff and thank you for staff work and efforts through the month of November. Also wanted to let you know, from time to time, we receive emails from members or calls where they want to actually reach out to specific trustees of the boards, or they have questions for board trustees. We do our best to address those questions and try to keep you apprised of what they are, whether it's through my oral report at these meetings or specifically to let you know through emails. So what we're going to be doing is we are going to be establishing 2 emails in our website, one for police and fire members, trustees, and one for federated members. And when members want to reach out specifically to a trustee of a board or have questions generally for the board trustees, they are going to be reaching out to that particular email. The administrative team will be monitoring the email box, and then we will forward those emails to the appropriate trustee whenever they come on. So I just wanted to let you know, it's not going to be an email of your email address, but it will be a general email of the board for questions from members. Lastly, I wanted to let you know that the office actually will be closed from December 23rd to December 26th, and again from December 29th, 30th through January 1st. We are going to be open for the city, what is called the city holiday closure from the 27th to the 29th. That will be Tuesday, Wednesday, and Thursday to provide customer service during the holiday. And there will be normal business hours by the benefit staff. Again, that will be Tuesday, December 27th, Wednesday, December 28th, and Thursday, December 29th. That, Mr. Chair, concludes my comments, and I wanted to take this opportunity to thank all of you for your hard work and dedication for the board and the plans throughout calendar year 2022, and wish each one of you and your families very happy holidays. And also take this opportunity to thank all our staff for, again, their hard work and dedication throughout the year, working for the plan members and making sure that we meet our core duties. So thank you, everyone, and happy holidays to all. You are mute, Mr. Chair.
Thank you. Thank you for the presentation and for your warm wishes for the holiday season. Are there any questions from trustees for Mr. Pena? I did have a question just to clarify. When in the past, when you have received inquiries from the public targeted at specific trustees, you have sought to answer those directly yourselves by staff, but have you informed the trustee that a question was targeted to a specific trustee?
I know I have done that, and we will try to continue doing that. I can actually speak in all cases, Mr. Chair. There's a possibility that we have received some basic questions that we have not bothered to let the trustee know. But I think our goal here is to keep trustees apprised. And we have received some specific questions or requests that members really want to reach out to trustees. So certainly we'll take them one, as they come. And I suspect that we may reach out to the trustee as well and suggest some responses based on the questions. But certainly this is more for transparency purposes. We want to make sure that members know that they can actually have access to their board members, and we're going to just have a general email in the respective websites. Barbara, any other comments that you want to share with respect to that?
Yes. Yes, this was actually as a result of a member's comment on our website survey. And so a member had said they couldn't see an email address to contact a board member. So this was our method of addressing their comment.
Okay. Well, I think as a rule, I think it's great if you are dealing with the inquiries at staff But if something is directed at an individual trustee, I believe we should at least be made aware of it, so we know that there's someone out there who is asking after us. If that is in fact what has happened, so.
I agree, and this is why we have created those two emails. So we will do that going forward, Mr. Chair. Thank you.
Okay. Any other questions from trustees or from the public for our CEO? All right, thank you. And on to item 5B, oral update from our city council liaison. Is Councilmember Davis here?
Hi, yes, I am here.
Great, thank you.
You're welcome. I don't have a lot of updates. I usually have more updates when we're in budget time, but of course I do want to just do a, make sure everyone knows we had our last council meeting of the year on Tuesday, and when we reconvene in January, I believe it's January 10th, we will have new council members in 4 districts, and we will also have 2 empty seats. So of course, Councilmember Mahan will be the mayor, and so District 10 seat will be unfilled as of January 10th, and District 8, Councilmember Arenas is moving up to the Board of Supervisors. She got elected to the Board of Supervisors, and that seat will be empty. We will have new members in Districts 1, 3, 5, and 7 as of January 1st, but our first meeting is the 10th. And so we will have a brand new board, and there will be a lot of need for them to get immersed in new subject matter to them, obviously. And the Federated pension, as well as the police and fire pension, is one of those. So I hope that Roberto and the whole team have a plan for how they're going to orient those new folks to the pensions and kind of the ins and outs of our relationship.
Yeah, Ms. Davis. So we actually work closely with city staff, and there is an onboarding process that it actually includes a presentation, a combined presentation by city staff and by our office on the pension plans.
Great.
Unfortunately, this year, Jennifer, in the past, has been done combined by Sheriff Parkman and myself. I think Ms. Shembri is going to be scheduling those presentations. I believe is during the week that I'm actually not in town. But we will follow up with Jennifer, certainly make ourselves available. And I agree with you. As you know, you've been with us for a few years now. It's an ever-ending learning process. So we will do our best to make sure that we give them some of the basic knowledge that they need to try to deal with, these very challenging pension issues.
Will CIO Polani be able to attend in your stead? Because I think it's really important to hear from him for the new council members.
I'll check with Prabhu. I'll have to check with Jennifer the specific dates, but I'll check with Prabhu. Yes, we can certainly do that. And if we're not able to meet them with Jennifer Shembri, we can actually do a separate one-on-one with the new council members between myself and Prabhu. So certainly I know it's a critical issue. It's a big part of the budget. And so we want to make sure that we are part of the onboarding, which we have been in the past. I also wanted to mention, now that you bring this up, and this is also for staff, that we are going to be, the city reminded me, and we're going to bring back to both boards next month the discussion on the joint meeting with the city council for topics of discussion for that meeting, which at this point has not been scheduled, but we are considering again, ideally late February, sometime in March, ideally again before the new mayor have the big budget discussion publicly. But again, we have to work with the city staff and the city council and both boards on scheduling that meeting. But again, I think the main issue here is that next month meetings, both should include discussion on topics of discussion for that joint meeting. Thank you.
Thank you. That's it for my update.
Great, thank you. Are there any questions from trustees for our council liaison?
I have a question. Do you is there general idea when the two appointments would be for CD 10 and CD 8?
Yes, so our direction to the city clerk was to ensure that we have those interviews and make the decision before. Obviously, that's a council decision, but that we directed the decision to be made before the end of January. So the idea for going for the appointments for anyone who was following the conversation was really about the speed at which we could do the appointments versus the need to wait for specific dates for a special election. So we didn't want those two seats to go, frankly, those two districts to go unrepresented during the budget process, which was what was going to happen if we had done a special election, because we couldn't hold it before the end of May.
Yeah, no, I agree with the decision.
Yeah, so we're hoping to see
my personal opinion.
folks, before January or by January.
Right. Yeah, that'd be wonderful. Thank you.
Or by February, I mean.
With the turnover in the mayor's office and with in the city council, is there going to be a turnover in the the pension board liaisons?
That
Or is
will be-
tend to continue?
That will be something that is discussed on the January 10th meeting. So I have no way of knowing that at the moment.
Mhm. But is that something that typically happens, or these are longstanding assignments?
There is a possibility. I mean, I have been on the Federated Pension Board for 6 years now. It may be time for someone else. I don't know yet. I haven't had that conversation with our mayor-elect.
Mhm. But that would happen right up front on January 10th, you think?
Yes, the appointments get made right away. Yeah, because we actually, because so many council members are leaving, we, for example, we won't have a quorum with the number of members who are left in rules. So we had to cancel the first rules meeting of the year because we didn't have a quorum with just council member Cohen and I being left on the board on that committee. So.
And Ms. Davis, may I ask if this is I recognize the mayor works on those appointments. Is this something you can request to stay as the council liaison? Not suggesting that you should, and we love to keep you, especially because you have developed a knowledge that, quite honestly, it is hard to replace.
Yeah. So we have input into those appointments. We make requests.
So does the mayor make the appointments, or is that a vote by the council?
It's a vote by the council.
Okay, yeah, then that'll be fine. All right.
Speaking just for myself, I hope you choose to stay, and I hope the council chooses to vote you to stay.
Thank you.
And I agree.
Okay. Are there any other questions for our council liaison from trustees? Or from the public? All right, well, thank you so much and have a great new year.
You too.
All right.
Thank you.
Now we move forward to agenda item 5D, discussion, possible action on the board self-assessment. I trust all trustees have reviewed the report from Walter on our trustee self-assessment. And I open the floor to any comments or observations from trustees on how we ourselves think we are doing. Well, I will note that we generally gave ourselves reasonably high marks on most categories. I think the one standout for me was question number 17, which is please reflect on the typical length of a board meeting, excluding committee meetings. And 3 of us felt they were optimal, and 4 of us felt they were too long, and that was the preponderance of assumptions. So clearly there's a sense that the meetings run too long, And addressing that, I wonder if any trustees have any comments, observations, and or suggestions on how we might make the meeting shorter. And feel free to share whatever ideas you may have.
Mr. Chair, I just wanted to mention Volte Viola from Cortex is actually had joined the meeting. I'm not sure to what extent you're going to ask Volte to join in the discussion or to make any presentation or have any comments or questions for him, but I just wanted to let you know.
All right, I thought Volta would not be available, but if he would want to make any comments on the self-assessment as a preamble to our discussion, that would be great.
Sure, thank you, Chairman. Yeah, this is a self-assessment, so it's difficult to look at a time series of self-assessments over time because the board has some transition, but the general number there that was quoted was a 9.3 on a scale of 10, and that's better than 2 years ago. The surveys are done every 2 years, so that's good. No, I'll open it up. I'm happy to make observations at the chair's wish. But again, it's a self-assessment. It's improved since it was done 2 years ago. And like you said, the common issue that was raised was the length of the meeting. And my only observation is that that's typical of many boards. You want to be effective and you want to be efficient in doing so. And that's a challenge for all boards, is being as efficient in the process of being as effective as you can in your role as trustees. I'm happy to make more comments, but I'll leave it to the other directors to make comments.
Yeah, Chair Horowitz, I'm happy to dive in on question 17, because I was one of the people who I'll out myself who was in the 4. And there's a tension between being thorough and complete and giving every topic and every speaker time to share their thoughts fully and completely. So I'm quite sensitive to that. And I think that you strive to give everyone their due hearing, which is fantastic. I can only compare to my experience when I first joined, when Matt Lesh was chairman, and there were meetings back in that time that went for hours. So for me, it's not necessarily that things have to be done in 60 minutes or 90 minutes. I don't think that's feasible, and I don't think any of us should be serving if that's our expectation, because there are a lot of important issues. I think it's more within each topic, redirecting people. I think in our meetings, the same thing gets said over and over. I think some people ask unprepared questions, and it leads to meandering. And I think so that's a general observation. And I think this board is more afflicted with it than prior boards I've served on. So that would be one recommendation. The other thing is, I think the disability hearings are just challenging in general. And Matt was particularly adept at those, at both communicating empathy, but also wanting to make sure that the process was moving swiftly, and that we were seeking conclusion in an efficient manner. I think that's art. I would not profess to say that I could do as good a job as you've been doing. I do know that that's now also going to get moved out of the general trustee meetings, the board meetings, and moved into the special committee that has been created. So I think that's going to help a lot. So those are my observations.
Well, thank you, and thank you for your candor. Certainly, the disability hearings are by far the most challenging, and it will help to have the disability committee. It would be great if we could insist that applicants under disability be represented by counsel instead of representing themselves, because I think that goes to a lot of the length of those hearings. But I do believe there is a requirement to hear people out at their length in order to give the sense that we are having a fair and equitable process.
Past chairs have felt more comfortable to curtail the length when it becomes repetitive and not adding new information for the trustees to consider.
Well, thank you for that observation. I only shared a few meetings with Matt Lesh, but it sounds like he had a unique style in that regard. Any other questions or observations from trustees? I will out myself in saying that I too was amongst the four who said they were too long. So if it's feels too long on the listening side, I can assure you on the speaking side, I need to rest my voice every second Thursday of the month when these meetings are completed. And there is a tension between hearing out all our presenters at their length and effort to move things along to our benefit. I think these public forums are built for transparency, not for efficiency. And when you have meetings in the private sector, there's someone at the head of the table who can bang their fist down and saying, enough, we've heard everything we need to hear from you, and move on. I don't believe we have quite that luxury in the public sector. But if the consensus is that we do need to move things along more quickly, we don't know yet who will be the chair next year, but whoever that person is may elect to cut speakers off with a little bit more vigor than we've seen in the past, if that is the consensus amongst trustees.
Well, I think the responsibility is on trustees too. I don't think these are that at least certainly my answer to question 17 wasn't directed at one person. You may have the baton, but we're all making the music together.
Okay, well, it's thank you for that musical analogy. That is true. And in fact, I think if we did a time study, the bulk of the time is consumed by presentations from our consultants, our advisors, et cetera. And our questioning consumes a relatively small portion of our time budget. So it is important to hear from all members of all trustees and from members of the public. So, well, I don't believe any action is required on this item. So if there are no further comments, are there any comments from the public?
Trustee Horowitz or Chair Horowitz, it does say possible action. I do think that the board should vote to adopt the self-assessment.
So to accept the findings.
Correct.
Okay, do we have a motion then to accept the findings?
I'll make such a motion, Trustee Chandra.
Okay, so we have a motion from Trustee Chandra. Do we have a second?
I'll second Trustee Linder.
We have a second from Trustee Linder. Any discussion on the motion? Any public comment on the motion? If not, we will vote. Vice Chair Jennings?
Aye.
Trustee Chandra?
Aye.
Trustee Linder?
Aye.
And Trustee Avasti?
Aye.
And I vote aye as well, so it is accepted unanimously. Move forward to the next agenda item.
I think staff's pulling it up, but just for expedience purposes, the next agenda item is election of the board chair and vice chair for calendar year 2023.
Okay. And that in fact is item 5E. So I believe last time we had nominations and there was a single nomination for both chair and vice chair. Council Chin, correct me. Is it possible to open the floor to new nominations at this point or additional nominations?
No, because the nomination period has already lapsed.
So we don't have an off ramp here.
Correct.
No.
Very well, then I will, I guess then simply proceed with election for the chair and vice chair. We'll take the chair first. There was one nominated candidate, myself. This is not a question of a motion and a second, but a simple roll call vote. Is that correct, Council Chen?
That's correct.
Okay, so Vice Chair Jennings, how do you vote on the nomination? Vote aye. Trustee Chandra?
An enthusiastic aye.
Enthusiastic aye. You only get one vote.
But I can add adjectives.
You can, but this is not Chicago. Trustee Kelleher? Trustee Keller, are you on mute?
Not here, is he?
Oh, I'm
Right.
sorry, he's not here. Trustee Linder.
Nice try for the off ramp, but I actually vote aye as well.
Okay, and Trustee Avasti.
Aye.
And I will abstain, if I may. And so it is passed that the nomination moves forward. And the nomination for vice chair is Vice Chair Jennings. And we'll have a roll call vote for that nomination. Vice Chair Jennings.
Oh, I'll follow suit and abstain.
Very well. Trustee Chandra,
I vote aye enthusiastically.
again. Trustee Linder,
Aye.
Trustee Avasti,
Aye.
and I vote aye as well. So both nominations carry forward for the 2023 calendar year.
And may the record reflect that trustee Kelleher did not participate in that vote.
Exactly. Thank you. And now on to 5G, which I believe we turn to Council Chin for some information.
So as we all know, the governor's proclamation for the state of emergency continues to be in place. And the city council continues to recommend social distancing in city facilities. If this committee or board adopts these two factual findings by majority vote, you may continue to meet virtually for the next 30 days.
Thank you. So do we have a motion to accept these findings and to continue to meet virtually?
So moved.
We have a motion from Trustee Linder. Do we have a second?
I'll
Second.
second.
It sounded like that was Trustee Chandra.
Yes.
Any discussion on the motion? Any public comments? We will vote. Vice Chair Jennings,
Aye.
Trustee Chandra,
Aye.
Trustee Linder,
Aye.
Trustee Avasti,
Aye.
and I vote aye as well. It passes unanimously. Now move to agenda item 6.1, investment committee reports. Trustee Chandra, would you like to present? It looks like we only have a special meeting.
Yeah, that's correct. Our committee, as you know, is meeting next week. And so I guess that would be in January. There may be some update coming out of that. So nothing at this time.
Okay. And then continuing to 6.2.
Actually, could I ask a question? Were we supposed to do something with 5F, discussion and action on committee assignments?
Oh, did I miss that? I'm sorry.
Yeah, I guess we missed that one.
Yes, you were quite right. I apologize.
No worries.
It's not too late to rescind that nomination and vote, by the way. 5F, discussion on committee assignments. And I don't know, do we have an attachment that we can put to the screen? And the item here is based on the fact that, as we discussed, the disability committee is formed, and they will be going through some extensive training to prepare them to begin hearing disability appeals. And currently there are, as with the other committees, only 3 members assigned. And the thought was that we might assign a 4th member, an auxiliary member, to go through the trainings so that if there is a committee member absent, we would still have the opportunity to move forward and have the committee hearings. And given the current arrangement of committee assignments.
Mr. Chair, can I ask staff to bring that up so that everyone can see the arrangements? Staff, can you actually bring the attach?
I
have it up. You cannot see it?
No.
No.
Okay. Let's see.
We still see the agenda.
I have it up. And I have share screen capabilities. Do you want me to pull it up, Linda?
Let's do that.
That would be great. Thank you.
Okay, yeah, of course. 1 second. Oh, it looks like the host disabled me. Okay,
Looks like you're the host.
I have
now,
it up
or-
now. Yes.
Okay.
Can you guys see this?
Yes,
We can.
thank you.
Do you want me to
Though-
make it bigger?
Scroll up because we can't quite see the disability committee.
Okay.
There we go. So currently, disability committee is chaired by trustee Linder and with Vice Chair Jennings and trustee Kelleher. And the thought again was to add a fourth, what are we calling this? An auxiliary member or a adjunct member?
Alternate.
Alternate member. Thank you. Knew it was something with an A. An alternate member. And given the existing committee assignments, I don't know if anybody would like to volunteer to be on the disability committee, particularly to go through the trainings so we didn't have to go through them again if there's a need to add another member in the future, or to, if the disability committee isn't able to form a quorum at any particular time in the future. So we would like to have someone else go through the trainings with the disability committee that's coming up. How many trainings? I think you mentioned, Roberto, 3 sessions?
We are right now, Barbara, correct me if I'm mistaken, we're thinking about 3 once a month, starting with this afternoon, December, January and February, before we actually bring the first disability cases to the new committee of disability of form of trustees of your board.
Yes, and the training sessions will be recorded, so they can be viewed after.
Oh, okay, well, that's helpful. Okay. So,
Chin, because this board is comprised of 7 members, obviously we want to make very clear that this is just an alternate, and at any given time, we certainly do not want all 4 trustees at the meeting, because that will constitute a meeting of the board as well, correct?
That's correct.
I just wanted to make sure that that point is clear, so that we don't have an issue on that side.
So the alternate is for training right now, and if we don't have a quorum, the alternate gets added in so he can do the hearings.
Yeah, he or she can do it, correct. That's correct, Chair
Okay.
Linder of the Disability Committee, yes.
Okay, so I think we have 2 choices, right? There's trustee Chandra or trustee Avasti. I think we had trustee Kelleher here, so we would have a non-city perspective.
That's right.
So trustee Chandra offers that, but trustee Chandra is also very busy, and I don't think the disability is something they might find.
No, I would like to invite trustee Avasti to be our alternate.
I agree.
Yeah. So in terms of hours, like what is the time commitment? I mean, and I'm asking because my city calendar is all full for the next 1 month.
I know.
It's hard to say, trustee Avasti. I believe, well, if you just the alternate, I believe you're mostly going to be involved in the next few meetings just to get the training. If you're not able to attend the trainings, they're, as Barbara indicated, they're going to be recorded, so you can always do yourself on our website. Now, in the event that we lose a trustee, again, it may require more of your time for the disability committee. But as an alternate, at this time, I wouldn't expect it to be that time consuming.
Assuming that all the disability committee members are present.
Correct.
And let me ask this about time. Last month, we had 2 disability hearings. One was time restricted and the other wasn't. Is it possible that they can all be time restricted in the future? How did that come about?
Sure, I can speak to that. So one of the appeals that we had come through was time restricted because we had some indication that one would be challenged in court. And so what we did was we met and conferred with the applicant in advance of the board meeting to set forth the procedures. And when there was a mutual exchange of information, and presented that to the board as well as simultaneously the exchange materials, and both sides agreed to a time certain.
I see. So that's something that we can strive for, but we can't
We
count on
certainly-
in every case.
We can certainly strive for it. It really depends between the parties which are dealing with that particular item. So the item I dealt with was not a disability issue. So it came directly to me as general counsel for the plan. So I approached it a little differently,
I see.
but we can certainly
another-
do that for the disabilities.
We can't, we can make it time restricted.
We can,
I mean, like what, we can or cannot?
we can.
Great.
Yes.
I think that's
but not-
appropriate.
But not in every case?
We can in every case. I
Okay.
do think there is an issue that, Chair Horowitz, you mentioned, it's that part of these administrative hearings is for the member to feel like they've been heard for their due process rights. And so it is incumbent on us to allow them to present. But if we let them know in advance that they only have 15 minutes and another 15-minute questioning period, they're on notice that this is going to occur.
Mhm. Well, my
And-
main thing is that it's not 2 hours, right?
Well, there's obviously there's a big range between 15 minutes and 2 hours that can be
Yeah.
negotiated. So
That's correct.
that's reasonable. And another
Really-
question,
Mhm.
so up till now, a committee comprised of staff heard the initial appeal. Could that continue to be the case? And then the disability committee only hears cases that go beyond the staff-based disability committee?
I would have to look back at I don't know the answer immediately off top. I would have to look back at our disability committee charter to see how those are routed to the disability committee.
I can speak to that,
Okay.
Councilor Chin. The committee of the trustees was purposely created to take over the committee of staff. And so what this new committee of trustees is going to be taking over is what staff have done in the past. Otherwise, what you will be doing is actually adding an extended time to the process because all these applications have to eventually end at the board for board approval in any case. So if we do what you are suggesting, we'll be adding another step. There was also the situation which was one of the main reasons I raised the issue to begin with, was there was a point where staff was really not, supporting staff's recommendation. And I just always felt that the board will be much more inclined to take a recommendation from their own peers. So that's why the charter was created to function as the disability committee instead of having the staff. I also like to take this opportunity to mention something that Barbara just reminded me, which this board can consider, which is each one of your committees have 3 members, but there's nothing to say that your disability committee can be comprised of 2 members and 1 alternate. So that will make it easier. You could make the current trustee, I can't see his name, if you can move it up a little bit, Councilor Kelleher, the alternate member, and then leave trustee Jennings and Linda to be the actual members. And so that way you wouldn't have to be adding another member to the committee. Just a suggestion, she just reminded me, in fact, that's what Police and Fire does. They only have a 2 committee member for disability, although they do have a number of alternates from each side of the equation. But for the most part, those are the only 2 members that are involved in the disability process. So you could take that same route and do a little different rather than adding another alternate to the 3 that you already have on board. But it's
Well-
your board.
Well, if I may respond to that, I believe the disability committee charter provides for 3 members. And so if we were to go with Barbara's suggestion, we would have to amend the charter and come and bring it back before the board for approval. Just putting that out there if that's for the board's consideration.
Roberto, I have a question. I mean, if you keep it 3 and only 2 are able to participate, you have quorum, right?
Correct. Yes, we do.
So,
yes, I think that, one of the issues, Trustee Chandra, is there might be some situations where Trustee Kelleher may not be available in the future. And so we also are considering that in the equation, right? So, because if that's the case, then that will actually leave only 2 members. And any time that one of those 2 members is not available, then you won't be able to meet.
Correct. So the main purpose of this is really to get an alternate member to participate in the 3 trainings that are coming, just because for efficiency purposes for staff.
Okay. Well, yeah, okay.
And in this way, with 4 members, either true or alternate, our chances of having at least 2 members available to hear an appeal will be increased. And we do have again, a pretty good docket of applications that are coming. Is that correct, Mr. Pena? Yeah. So it sounds like efforts can be made to restrict the time of hearings and negotiate agreed upon time limits with the applicants. So knowing that, I don't want to force this on anybody by any means. Does that sound like something you could commit to, Trustee Avasti?
Yeah, I mean, for the alternate part in the beginning, I hear that the trainings are recorded, so that gives me some flexibility. So I'm willing to take up the alternate responsibilities. One request that I would like to make is that if there is no quorum, if you let me know in advance instead of, like the last minute that, there's no quorum and on the last day I'm required to attend, that would be challenging given the fact that the department that I work for is relatively new. So there are like a lot of responsibilities there. It would be easier for me to work on the time commitments that I have.
Yeah, and to follow up on that point, these disability applications are very, very technical. And so to the extent we can come up, I believe we already approved the disability committee meetings earlier today in our meetings, that we could try to give you at least a month's advance notice.
All right. That works for me. Thank you.
Okay, so do we need action and a vote on this, or?
Yes,
I believe so.
Yes.
So I'll make a motion, and does that motion now include the addition of Trustee Avasti as an alternate to the disability? Because we didn't have that there, so I'm going to nominate the slate as presented with the inclusion of Trustee Avasti as an alternate for the disability committee.
Okay, understood. That was from a motion by Trustee Chandra to add Trustee Avasti as an alternate to the existing disability committee. Is there a second?
I'll second that.
Let Mark second. Yeah.
Okay, so we have a second from Trustee Linder. Any further discussion from trustees? Any comment?
Horowitz, I do have one comment.
Okay.
Does the charter as currently written allow for an alternate to be assigned to the committee? Or
does that prohibit it?
Does that need to be updated?
We can certainly look at it, but for the purposes of adding an alternate, I don't think it precludes that.
Okay, certainly an important question we probably should have asked at the beginning. All right, so we have a motion and a second to add an alternate to the disability committee. Any further public discussion or public comments? We will have the roll call vote. Vice Chair Jennings.
Aye.
Trustee Chandra.
Aye.
Trustee Linder.
Aye.
And perhaps most importantly, Trustee Avasti.
I abstain.
Okay, well, we're going to take that as an aye. And I vote aye as well, so the motion passes. Congratulations and welcome to the Disability Committee.
Thank you, everyone, for your participation and comments.
So if we can return to the agenda, I believe 6.2. And I forget which committee that was a report from.
There was no report out from investment committee. I shut down my iPad, so I'm not sure what's next either.
Right, no, there was, 6.2 is governance
Excuse
committee.
me, Mr. Chair,
Yes,
you need to receive and file 6.1 B and C.
Oh, I apologize. That's right.
Oh,
That's my
okay.
fault. Not sorry, Chair Horowitz.
Okay, so I move that we receive and file, if I can move,
Oh, you just receive and file. We don't need to make a motion.
oh, is that right? Okay.
Yeah, that's
thank
correct.
you. Okay, great. Governance Committee. It looks like the last meeting was a special meeting, so I suspect, who's the chair here? Is that?
I
Terrence?
am, yeah. Nothing to report.
So we can also receive and file from the Governance Committee. And then moving on to item 6.3, Audit Committee. Looks like Chair Kelleher is not present. However, the
Yeah.
last meeting was simply a special meeting. So unless another.
Correct. It was
meeting-
just a special meeting, Mr. Chair.
Okay, so if no of the other committee members wishes to speak, we will receive and file the minutes of the Audit Committee. And then the Disability Committee. Again,
It's just a special.
a
Yeah, we
special
had-
meeting, and there's nothing to file.
That's right.
And finally, Joint Personnel Committee. We did have a meeting there, and I
Mhm.
believe Chair, I forget, Trustee Chandra is either the chair or vice chair of that committee.
Oh, JPC, I am I was chair for all of 2 months and now I'm the vice chair going forward. I guess technically I'm chair this month still. So just a very quick report out here. The committee continues to work fairly hard at trying to determine whether or not an incentive compensation structure makes sense for the CEO and the CIO's office and staff. And we are, I would say, partway through our work, and we are meeting monthly, and we'll continue to report out to this board as we get more clarity.
Okay, thank you. And then agenda item number 7, you can all review the Cortex report. Are there any proposed agenda items? All right, then this meeting is adjourned. Please, everyone stand by for individual committee meetings.